Hello, James Ball, Certified Financial Planner, Medallion Financial Resources, Venice, Florida. We want to talk today about Roth Conversions. Today's environment, we have 10,000 people retiring daily, and those people have IRAs, 401ks, 403bs, various qualified programs. They're now going to get ready to retire, and they're going to use that to substantiate their standard of living in retirement. Well, all of us today, and including those folks especially, have concerns about what's going to happen to their qualified accounts as they take the money out because of tax rates. So when you think today, just take a second here in your own mind, where do you think tax rates are going in the future? With our debt situation today, it seemed maybe kind of obvious that it's only one way they can go, but everybody feels differently about it. So you can just kind of think about where you think the tax rates are going to be. But let's take a look at some facts when we talk about potentially why do we think maybe they're going to have to raise the tax rates. I have up here the U.S. debt clock, and at home, if you ever want to look it up, it's usdebtclock.org. It's also on our website, which we'll put up for you at the end of this presentation. And please feel free to go to our website. There's no cost or whatever, and you can look at the debt clock anytime you want. But the debt clock shows that currently our debt is $30 trillion, almost $900 billion. It's $245,191 per taxpayer. So, if we were all really nice and we love our government, we'd write them a check for $245,000 so we could get out of debt. Well, that's not going to happen, obviously. So, but kind of what's causing all this? Well, if we take a look here, federal spending is at $5.9 trillion. Federal revenue is at $4.4 trillion. So there's a $1.5 trillion deficit, and that's the crux of the problem. We're spending more money than what we're bringing in, and just like in our homes, you can't continue to do that. Deficit spending just doesn't work. So, the government's going to have to do something to cure this problem, and I think they're going to lean on the taxpayers for that. In today's environment, they have two ways they can help this debt situation. They could reduce spending. You see that happening? No. Or they could raise revenue. Well, how do they raise revenue? And they'd have to do it through taxation of our citizens. And so let's just, if we take a look, we say that the debt is $30 trillion, almost $31 trillion now. But the thing that's scary is that's really not the right number. If we take a look today, our debt is $143 trillion, $672 billion. And well, Jim, where'd you come up with that number? There's actually two very large obligations of the federal government that they never recognize in their accounting of the situation. Those two other items are Medicare and Social Security, obligations to our citizens. So when you take a look at those obligations plus their other debt that they have, the government has, it raises it to $143 trillion. So, I mean, it's just a chunk. So, what is the government going to do to alleviate that? I think they're going to have to lean on the citizens, and the current administration's currently doing that, hiring 87,000 additional people in the IRS to audit to see if they can come up with some additional monies, etc. But so now we have this situation, and you have this kind of debt, or you have this kind of money in your IRA looking at potential taxes on that money. Is there anything you can do? And yes, there is. If we take a look, this lady, a client of mine, in fact, is 70 years old, and what she's doing is she's got $500,000 in her, well, she has more than that, but she's on her IRA. She's going to put $100,000 into this policy for 5 years. The policy's going to go ahead and pay the taxes for her. And so what she's got a situation here is that she's getting $500,000 out of her IRA, and yet she doesn't have to go out of pocket to write the check to the IRS for those monies. So a very tax efficient way. And there's also $1 million death benefit here that she wants to leave to her brother. So we're alleviating a $500,000 tax liability, income with a tax liability, and giving her brother the $1 million that she wanted to accomplish. So there's an excellent way that we can do it. Now, I'm just going to hit another area real quick here. Not necessarily for you folks, obviously, at this point in your life, if you're retired or close to retirement, but for your children even. If I can catch them young enough, if we look at doing a 401k versus a Roth, and in this situation, let's say somebody does a 401k, they put $10,000 a year in for 35 years, they can make 5%. They've got a pool of money at $948,000. Well, if you look, what was the tax savings? Well, $10,000 per year. If they're in a 21% tax bracket, they save $2,100 per year. Take it times 35 years, they save $73,500 in taxes. That's great. Nice, really nice. So at retirement, then the $948,000 is going to be taxed at 21%. The tax is $199,156. They save 73, so you can see the $125,000 there. If I can find people young enough, and by the way, I'm saying $199 in taxes, they're not going to pay all that tax just in 1 year. They're going to spread it out over their lifetime. So this $199 is not correct. It's going to be, $300,000 or $350,000. But there is a way that we can alleviate that by doing a Roth type vehicle, and we can have the income come in on a tax-free basis. And remember, it's important how much money you have coming in. It's even more important how much you keep. We're going to put our logo up here, and if you ever have any questions, just give me a call. Check out the website. No obligation on your part. Be happy to take a phone call and chat with you. But I wish you all the best in 2022 and into 2023. And thanks for listening to our presentation today.